Good morning and welcome to the Daily Energy Markets podcast. It is the 6th of May, and we have Brent crude oil trading this morning a little bit up at $83.44. That's up about 0.5%. WTI remains below $80 a barrel at $78.59. Let's kick off this morning, as every Monday, with Omar Najia, Global Head of Derivatives at BB Energy. Omar, I think you called it the last few weeks when you said that it was unlikely the warring factions in Gaza would reach a ceasefire. It seems that's falling apart. Would you expect that to provide the next momentum for prices to move out of this current position?
Well, I think they will move out of this current position, but I don't think. I mean, I think that the geopolitical premium, I don't think is much to do with Hamas and Israel, and I don't think anything's going to change. I think they will go into Rafah. I think they will attack Lebanon, etc., etc. But I think basically it's giving like a floor to prices more than an impetus, basically, to the upside. So it'd be dangerous, if you like, to strategically sell oil looking for lower prices. And our view basically hasn't changed. I mean, even though the market has come off, we look at this as being basically a move that we've seen on WTI from December. We traded about, let's call it 67.50. We went up to 87.50, and that was the first kind of push to the upside. We're getting a retracement down from 87.50 down to, call it, $78 plus or minus, and we think from here or hereabouts, we're going to have another third push basically to the upside. We think that markets are correcting, be it the S&P, be it gold prices, be it oil. We think they're correcting basically to the downside. We think the dollar is about to go low as well. So yeah, not much has changed for us. So same views across the board.
Mukesh Sadhev, a Senior Vice President, Head of Downstream Oil Trading at Rystad Energy. Good morning, Mukesh. You're in Norway today, usually in Australia, so it's literally spanning one side of the world to the other. But if in Asia, we've got the Saudi OSP, official selling prices, published over the weekend for oil moving into Asia. Once again, the Saudis have raised prices, June crude prices for most regions, including Asia. They seem to concur with Omar's views. Your thoughts on what it tells us, the Saudi position?
Good morning, everyone. Yeah, Sean, good to be back here. We were also of the same opinion that the Saudi OSPs would increase, and I think between that range of $60 to $70 a barrel, they have even come out stronger. So I think this clearly indicates a few things. One, Saudis are probably as the block keeping an eye on the backwardation in the market. I think that's what they probably fear the most, that anywhere when market loses any signs of backwardation, I think they would want to keep the prices high so that there is some more pressure for refineries to pull those barrels. Number one. Number two, I would say that just on the oil price, Sean, I think now I feel like kind of repeating, like hang in the 80s has been kind of our catchphrase from our data analysis. And I think this has turned out to be true for the last almost 6-7 months since we have been watching this space. And the prime reason in my mind is what I call the oil circular reference happening in the Middle East, where we have indeed seen lower crude exports, but over the time, Middle East has been exporting almost 1.5 billion barrels more products to the market. So if you cut crude from the market and one hand and you provide 1.5 million barrels more products to the market, I think the impetus for rest of the world refining system or the hunger for crude reduces. So I think I would say that OPEC has been doing a fine and a great balancing act by using the crude markets and the product market and keeping the oil price between the 80s and the 90s. So I kind of concur with Omar that this 80s could more like a floor rather than anything else.
Bora Barryman, managing partner at Hormuz Straits Partnership. We also, I mean, with this geopolitical backdrop, Bora, we also had the big noise last week from the Fed and the jobs report coming out in America late in the week. In some ways, a little bit conflicting. The Fed midweek saying that they were going to have to stay higher for longer on rates because the momentum if you like, in the fight against inflation had sort of run out of steam. But then at the end of the week, we got a less than expected jobs growth number, still a sizable increase in number of jobs created, but not as was expected. Your thoughts on those two data points coming out of the US and what they tell us about the direction of travel for rate cuts?
Yes. Well, first, I want to kind of remember a comment that I made toward the beginning of the year when the Fed gave guidance that there could be 5 or 6 rate cuts. And, patting myself on the back, my comment was the Fed reserves the right not to follow its own guidance. And
Right.
it's not following its own guidance. And it's sort of sticking to this sort of, depending on the data, we will take appropriate action line. I look at the jobs report, and in the big picture, we're still at record or near record low unemployment. The Biden administration is patting themselves on the back over that same jobs report on that basis. And, if employment and price stability are the objectives, I don't see any reason for the Fed to reduce interest rates just to make oil markets happy or to make the stock market happy. The jobs appear steady and prices are nearing stability. So it looks like the rates are at a sweet spot and a sort of
But
a
in that
decisive.
regard, just to challenge the thesis, have they got themselves caught in a little bit of a corner? Because they did signal both previously and again last week an unwillingness to increase rates, which you would normally do if inflation is stuck at 3%.
That's an interesting observation. Look, I'm kind of taking the view that 3% is the new 2%. And you're correct, though. The U.S. Congress, Biden, they're embarking on a massive fiscal stimulus on infrastructure.
I mean, Jesus.
I mean, it's embarking in they're embarking on putting the pedal to the metal, right?
I think the metal is burnt out. I don't think it's a floor anymore for that pedal
The tax receipts are massively lagging the acceleration, let's say, of spending. So 2 trillion of debt issued over the past 12 months. Last time I took out this statistic, it was 6% of GDP. Now it's 7.2% of US GDP. That is, underwriting the energy transition, the Inflation Reduction Act, the Ukraine war, the Israel war. So to me, it looks like the Fed is the boy with the finger in the dike of this inflation overhang. And, what will the dike break whether the boy takes his finger out of the crack or not? So that's the big picture that I think Omar likes to sort of use as a theme of his commentary. But I see that it's a very precarious situation. There's a lot of pain going around, especially on the working class of many countries. I'll leave it at that. But I mean, one of the examples was the earnings reports of all these food companies last week. The McDonald's, Nestle, Coke, Pepsi, they basically said, our core customers are not able to cope with prices, and they are paring back their consumption. So this is at the near record unemployment and buoyant outlook on markets. People are struggling. So I see that this is going to kind of have an impact on politics, but I can't imagine that the Fed will really put in like more than 1 or 2 rate cuts before the election. So we're going to kind of muddle along in this type of situation for a while.
Omar, I mean, one of the things that this has triggered, this muddling along with rates higher for longer this year, more than expected, is delivered a stronger dollar than expected. I mean, most profoundly in the pairing with the Japanese yen, which seems to be its own weird narrative, trading above 160 yen. But across all the currency pairs this year, at least, the dollar remains a headwind. Or the question ultimately is it a headwind for energy demand, given everything priced in dollars for all of those economies buying a lot of commodities, buying a lot of energy, a much stronger dollar this year than expected? Is it any headwind to your bullish outlook?
No, I don't think the dollar is stronger than expected. And I think basically the dollar is going to weaken considerably, whichever way that you want to look at the dollar, whether you look at it geopolitically, whether you look at interest rates, whether you look at debt, whatever you look at, basically, the dollar is going to head considerably weaker. And what's interesting is that, people tend to forget. I'm always amazed how people they're like goldfish. They focus on the last, 6 hours, 3 days, whatever it is. The dollar had a massive rally into, I think, that ended sometime in 2022, 2023, a rally that lasted 12 years. Okay? Since then, the market has turned over. So we set lows in the euro, we set lows in the GDP. That's basically turned around. So I think basically that we're going to go over the next 3, 5, 7, 2 years, we're going to see basically the dollar weaken over time. Why? Well, I look at graphs, but if you don't want to look at graphs, think about it geopolitically. The dollar basically has been weaponized. So why keep all of your money in dollars? Why not make it 10% or 20% or 30%? The dollar basically has been devalued since the Second World War. Will continue to be devalued. How do we know? Because their debt is massive and unsustainable. They can't pay for it, and the only way you pay for it is by basically inflating your debt away. And the way you inflate your debt away is basically you debase your currency. So it used to cost you $1 to buy a Big Mac. Now it's going to cost you 10. In the 1950s, you used to buy a Big Mac for 10 cents. Now you buy a Big Mac for whatever it is, $1.
But in the context of the immediate term, clearly the medium term is a narrative, as you outlined there very credibly. But in the immediate term, in the second half of 2024, dollar strength, if we see higher for longer rates, the euro cutting rates, we see the Brits cutting rates, Japan doesn't even have rates, that dollar strength into the second half of the year to where oil demand would be picking up.
There is no statistically relevant correlation between oil prices and the US dollar, measured as I forgot what the DXY, as DXY. There isn't. It's not like an opinion. It's mathematics. It's mathematics. Right. So there is no correlation between statistically relevant correlation. Doesn't mean that when something goes up, the other thing doesn't go up. But statistically relevant, does it consistently over time, blah, 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 doesn't exist. So the answer is no. So people like to assume that, if the dollar goes up, then this goes down, then that goes up. But that's not true. I wish it was that easy. I wish the dollar's going up, sell oil. Dollar's going down, buy oil. It doesn't work like that.
Mukesh, Rystad Energy at IE Week, in your very impressive presentations, made the forecast outlook that the second half of 2024 would be much tighter and would allow OPEC to start to unravel its cuts, or at least to consider it. Obviously, the decision is in their hands, but the market fundamentals would support that if indeed they decided to do that. Where's your position on that now? Does that remain the same? Do you guys still see the same tightness in the second half?
Thank you, Sean. No, I think the OPEC related to OPEC cuts, we certainly believe in good refinery runs coming from, let's say, April to July, August period. And our hypothesis is that there is a part of the world which will run because they have commissioned new capacity, which is Middle East a lot, Asia and China. And there is another part of the world where the demand is, still recovering and expect to recover as summer comes, which is the OECD and the developed world. And that part of the world will run refineries in fear a bit of not sure how the Middle East will turn out, because these are some new assets, new outages. So if the world is a global peaceful place with all trade flows happening as they should, probably we don't need those higher refinery runs. But given the fractured supply chains, our view is that we will actually run more than the world requires. And that brings a bit of the crude tightness in the second half. But I think on the other side, we also need to factor in that there is a lot of leakages of the sanctioned barrels that continues to happen. And as oil price is increasing, the chances of non-compliance and leakages will further increase. We have seen Kazakhstan, for example, submit some plans for overproducing in the first quarter. In the rest of the year, we believe that it will be very tough. So overall, on the numbers, I think the second half looks certainly tight. But because of the non-compliance and sanctioned barrels leaking into the system, our view is that probably OPEC will continue to roll the cuts. And even if the data might suggest that there is a potential for unwind, but our view is that they will likely roll the cuts. And I think we need to also remember that the turnarounds in the September, October, November timeframe are also coming ahead. And if the market is flirting with just a backwardation right now with 50, 60 cents month one, month two, that's not good from an OPEC perspective. They would like to at least see $1 backwardation. And with that in mind, and with the emerging October kind of turnarounds where demand will be lower, I believe that despite the tightness in the numbers, our numbers, probably OPEC will roll the cuts.
Or looking into Europe, obviously the Fed, the US signaling last week from the Fed governor, the higher for longer rates. Europe still seemed to be pointing towards a June cut. Do you think they will be they might follow the US guidance there, or will we see a divergence and the consequence of that?
Yes, I think there's more, let's say, probability of leaving things as they are at the moment. But in the macro picture, I think there needs to be some further stimulus in Europe, especially given the kind of headwinds on German industry. And of course, a lot of the plans of kind of revamping the infrastructure base of Europe to accommodate the energy transition, especially with respect to electricity transmission networks. There's been a lot of talk at Innovate Energy last week, one of these big kind of energy conferences, that there really needs to be a lot more investment put into adapting infrastructure for hydrogen, for transmitting power out of the bottlenecks where that are preventing kind of further expansion of renewables and implementation of battery technology to kind of optimize the energy system and balance the electricity grids. So that being said, if they don't do any of this, I think European industry is kind of at a dead end And
The if question is so dependent on so many things. Ultimately, I wanted to get your view on the if being dependent on the capital available. We have a article, big read in the FT, to say it's the $9 trillion question: how to pay for the green transition. Is there the financing? I mean, despite the European sort of political commitment to the transition, is the capital there? Are the banks behind it? Is there the financing for Europe to move ahead? We were already seeing two of the biggest energy companies, Shell and BP, back away from that commitment.
well, again, I think you will be in the American conundrum. You can always print your euros and make it happen like they're doing in the US. And it's a political decision how that's distributed. But yes, I think, the Europeans have been relatively more conservative with their rate policy. They can probably bring it down more firmly and decisively than the Americans without letting the inflation genie out of the bottle. And after all, I don't think it's European policy that drove this global inflation bubble over the past few years. It's the Fed. And my sense is, it's that mentality. Are they going to take the lead from the Washington Beltway, or are they going to set their own direction? If they were following the Beltway, they would leave rates as they are. But I think the facts on the ground, especially in Germany, would lead me to believe they should take a cut.
Let's go to the survey question. We saw last week a 6-7% drop in the oil price, and it seemed to be, a lot of it driven by what appeared to be a diffusing geopolitical risk premium, with the expectation that there was going to be a ceasefire emerging out of the Israel-Gaza invasion. Hamas says the latest ceasefire talks have ended. They were in meeting in Cairo over the weekend. So my question this morning is, how much geopolitical risk premium will we see return to the oil price this week on the back of this collapsing ceasefire expectation and the re-engagement of elevated hostilities with, as Omar pointed out, what has been the threat of an attack in Rafah, where there is over 1 million Palestinians from northern Gaza taking refuge. So how much geopolitical risk will we ignore? Number 4, that's an editorial error. So it's number 1, $5 or more, number 2, $3 approximately, or number 3, none. There'll be no geopolitical premium returning to the oil price this week. $2, $3 approximately, or 1, $5 or more, which is what we saw come out of the market last week. Will we see that go back? What's the view in this room? And we will take it forward. Omar, looking at this sort of bullish expectation, we've come back into the oil price range of where we were for much of the first quarter, that sort of low 80s after testing, and below 80 on WTI after testing 90 some weeks ago. I'm wondering, from your point of view, what the technicals tell us. Where can this market go, sort of launch again, up to 90, up to 100? Is there a set of circumstances that you would see that sort of reach to break out what seems to be stuck in the low 80s all year, except for brief moments?
Well, I mean, I think you have to look at this market strategically, or you look at it from hour to hour, or you look at the news. I don't know, but we look at stuff strategically. So the market has moved from December till a month ago, let's call it, up by $20 a barrel. It's now off at $10 a barrel. We think the next move is going to be up. I think over time, you're looking at new all-time highs for oil. I think the same is true. And also, if you look, I think the low is in, like the low is in for nat gas. So we look at Henry Hub, which is the deepest gas market in the world in terms of price, right? So we can see the price. And if you look at that, that seems to have set a low, right, at 1.48, something like that. It's now over 2. So we think that's going to go and set new all-time highs over time. And I think you've got to kind of you got to always be, I know people like to look at the news, but if you've learned anything from the war in Gaza and stuff like that, is that the news is something that people are trying to sell you. They're trying to give you a kind of their impression and say, this is what you should think, right? So anything to do with like Bloomberg saying that, Hamas is going to do a deal and somebody else saying this is very generous and then there's not going to be any war, everything is contained, we're going to find, none of that is true as far as I'm concerned. None of it is true. So I think basically that we are going to set new all-time highs. The Fed, whatever they say, they can package it any way they like, but they are going to cut rates simply because they cannot afford to borrow and they cannot afford to make the payments that they're making now for the debt that they have, let alone for the massive issuance of new debt that they need to make. So they can say whatever it's like. They can, talk on CNBC and CNN and say, yeah, everything's good and rates are going to be longer for longer and stronger and all this kind of stuff. They are going to cut rates. These markets are inflationary. It's the same thing. Yellen came up and said, I think about a year ago, 2 years ago, inflation is transitory. And it was put everywhere. Inflation is transitory. Don't you think inflation is transitory? And inflation is like 20% or 18%. I mean, so if you still can't get it through, kind of, have that concept that they're selling you stuff that they want you to believe, then, believe them. But we certainly don't. We think the market's inflationary. We think the S&P is going to go first to 6,000, then to 7,000. We think new all-time highs on energy. We think Bitcoin's going to fly. We think gold's going to fly. And it's all going to happen not because of anything, but because we've printed so much money. The debt is so catastrophically high. And not just in the US, in Europe and the entire West. It's basically one massive debt bubble. And the only game in town, the only thing that saves them, that keeps it going, is printing more and more and more and more. It's like that game you used to play when you were young, that musical chairs. And then when the music stops, you sit. Only now there's no more chairs, but the music's still going. People are just going round and round and round. When the music stops, there's not going to be any chairs left. So it's going to continue for a long time. It might be in the
sense of there might be anything left. I mean, that would be the sort of the consequence of a collapse of a dollar. I wanted to get, Mudhesh, your views on the other piece of this. Obviously, this obviously liquidity and the inflation piece, as Omar's articulated there. But the other big pillar for this oil price is China and all things China demand, and we're seeing China's sort of that we take overnight. We've got the Caixin PMI on services for April is easing, as it says, solid but easing. We've had the similar on manufacturing. We also have the gasoline demand in China expected to slow this year with a massive growth, continuous growth in EVs. I just want to get your views of where China is at, do you think, in terms of supporting this global oil market, this global oil price, but China demand. Increasingly, there's been calls for peak China demand, peak China, at least gasoline demand.
No, I think China is certainly a big part of the oil equation. And April refinery runs turned out to be much lower by March by maybe 600, 700, kilobarrels per day. So that certainly adds a little bit more concern about China. But as capacity is coming online, as summer, in the overall world is approaching, we believe that China's demand for crude will certainly going to increase. Now, from the 14.3s, whether we will touch 15.5s or 8 is a kind of a question mark. But the trajectory is for China to possibly buy more crude oil going ahead. So China, at least in the short term, in my view, will support the oil prices, and that could be one of the reasons we might see oil edging upwards from this floor of 80. Now, when we
I mean,
talk
China's
about,
typically price sensitive. They might be, you know, this low 80s would be possibly appealing, high 80s less so, no?
correct. No, you're right. But I think they might not be able to support. They may have drawn a lot already when the oil prices was high. So this may be the time to possibly buy. And as we approach the September time period, I believe they will increase refinery runs for sure. So the trajectory for China is to increase refinery runs. And again, that will be certainly supporting the oil price. I think the question around the peak oil demand, China EV impact, I think those are some of the, I would say, third order factors rather than the first order factors which might be impacting the market. Certainly the news plays more than what it is, but the fact remains that China has been, I would say, naphtha demand in China is also growing. Petrochemical is also slowly increasing, and higher petchem side will also support the refining side. So I see all signals from China, at least in the next 5-6 months, to be supporting the oil price rather than going the other way around. The big question in my mind for oil price rather than China is overall, we have seen the big weakness in diesel with diesel in contango. And I think jet, our numbers indicate that for year-on-year growth, we have almost 1 million barrels of refined products demand growth, and then about 300 of the non-refined products demand growth. Out of that refined products demand growth, almost 500 to 600 is still jet demand. So I think the biggest question for 2024 in my mind is, will we come out of the jet lag we have been since the COVID days? And if we continue in the jet lag, that is a bit more risk to the oil demand. But I think summer is yet ahead of us. Travel is yet ahead of us. And if there is some geopolitical, let's say, ceasefire or a positive environment, I'm sure the jet demand has a potential to come back online. But if we remain in this geopolitically torn world and there is more tensions, that may prove to be a bit dampening. So jet demand is a key one. China, I think, is still going to be positive.
Let's Bora, last word to you for a quick comment. I wanted to get your views on the I mean, obviously the point Omar is making about the Fed has no choice but to cut, and in fact he's right, because they're already doing that, aren't they? Last week, while they maintained rates, they eased back on quantitative tightening, QT. I'm wondering how you interpreted that sort of dual piece. We'll keep rates higher, but we'll ease on the quantitative tightening.
Yeah, I think you know, there are a lot of real world pressures on governments, and they need to address them. And with tax revenue lagging, that's the main point. There, kind of the tax revenue is not there. You need to make things happen because there's a political pressure to do so. So I agree that the easing is the way. I always say in Turkey we have this phrase "ala Turca," like Turkish style, and I feel like, and we used to say the West is called alla franga. So now the West is taking the alla turca style. They're doing, you know, like Erdogan has built a very actually strong industrial sector. It's dynamic. There's strong real growth. And exports are strong because people need to be employed, but it's based on money printing because the tax revenue is not there. And, you know, we look at these Westerners who used to, you know, pay taxes, but they're not paying taxes. They don't want to pay taxes. So because but where's the money going to? Not necessarily to benefit them if you're fighting whatever wars on the four corners of the world. Just print the money and make it happen. I think that's a theme. But allocation is the key thing. And my final comment is the interesting pressure on China from Janet Yellen is that the investment is too high of a share of Chinese economy. It's at 40%, and they're asking China to take investment down to 20%, like the West, and increase consumption. And I'm not sure that advice from Janet Yellen is actually in China's best interests.
Well, that would be no surprise. We're going to have to wrap it up there with Brent crude oil trading below $84 a barrel, although up about 0.75% this morning in Asia trade at $83.60 on Brent and WTI at 78.74. We'll wrap it up there and thank Omar Najia in Dubai, Mukesh Sadhev in Norway today, in Oslo, and Bora Barryman in London. Really appreciate your insights to kick us off the week, the direction of travel after a big sell-off last week. Will we recover some of those geopolitical risk premium that seemed to come out of the market last week? We'll wait to see. Thank you. See you every morning, 10:30 UAE time. All the best.
Thank you.
Thank you, John. Thank you, everyone.
Thank you, guys.
Bye.
You gentlemen.